Welcome to Taking Stock for the week ending the 25th of November 2022. I'm Kien, Trinh, and joining me today is our Equities Analyst, Daniel Ortisi, to stream to you all things share market. Welcome back, Dan, and guess what? Today is what they call Black Friday, one of the biggest shopping days in the year. And just wondering, have you contributed to the retail economy?
Yeah, it's great to be back here, and I've definitely been adding a little bit to the economy, perhaps to some of our star stocks too. Picked up a few electronics from retailer JB Hi-Fi, so I've definitely been adding. How about yourself, Kien?
Yeah, that's going to certainly support JB Hi-Fi, one of our star stocks. But I also have a few nieces and nephews, and just trying to do that Christmas shopping early to take advantage of these discounts, especially with rising interest rates eating into household budgets. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. So Dan, and speaking about interest rates, it was another positive week on the market, with investors anticipating a slowdown in the pace of interest rate rises going forward, especially in the US, while brushing off this escalation in COVID cases in China. Markets are anticipating a peak interest rate of around 5% by June next year in the US, while here in Australia, cash rates are expected to move towards that 4% mark in early 2023 before coming down.
That's right, Kien. It's important to say that we are in a really unusual situation. So fears of a global recession remain rife, but there are signs that the economy could be in for a soft landing. The AGM season here in Australia and the third quarter reporting season in the US suggests that corporate earnings have been remaining resilient, with around 70% of US companies meeting or beating expectations. Despite margin squeezes and rising interest rates, the earnings growth outlook appears to be supported by easing supply chain pressures, as you can see from the chart on screen. Additionally, the reopening thematic, which has benefited industries such as travel, tourism, hospitality, and brick-and-mortar retail, could provide further support to corporate earnings in the near term.
Yeah, let's focus now on the stock in that sector, Dan. This week, Qantas, they released another earnings upgrade, and they are benefiting from strong consumer demand and reduced capacity, leading to more expensive airfares, as we understand, and also higher profit margins. And despite its poor operating performance and even client servicing, it appears consumers have little choice if they want to travel. So the earnings upgrades can be seen with those strong earnings revisions on Stock Doctor over the last 3 months. But despite the strong price momentum, especially in the near term, for us, we don't consider Qantas as a long-term quality investment. Earnings are volatile and cyclical, and its significant amount of debt makes it vulnerable to collapse when cash flows dry up, hence the reason for its marginal financial health rating.
Absolutely right, Kien. And the risk really is evident within the airline sector when we remember that competitor Virgin Australia went into administration in April of 2020 before ending up in the hands of private equity. However, shareholders ended up losing everything. And of course, many people could have remembered the collapse of Ansett Australia over 20 years ago as well.
Yeah, and let's not forget, it is also disappointing to see the CEO, Alan Joyce, being paid quite an excessive amount of money, despite its poor operating performance, and shareholders really receiving a lackluster return over the last 5 years.
That's right, Kien. And another sector that has benefited from the reopening narrative is brick and mortar retail. And as you highlighted earlier, Kien, this week marks one of the biggest periods for retail spending in Black Friday and Cyber Monday.
Yeah, interestingly, the impact of rising interest rates haven't really had an impact on retail spending, with most of our star retail stocks reporting strong like-for-like sales growth. And some of the stocks in this sector have really attractive dividend yields right now. Take, for instance, you've got Wesfarmers and JB Hi-Fi. They could still represent opportunity as they continue to trade below their highs. Wesfarmers and JB Hi-Fi are currently on gross dividend yields of around 5.5% and 8.3% respectively.
And furthermore from that, Ken, to compare the retailers, you can actually run a stock filter and select the GICS classification consumer discretionary, then add the fields you're interested in, such as financial health, 3-month earnings revisions, ST30 TSR status, 1-year total return. And from this list, it's also interesting to note that amongst the worst performers over the year were the unhealthy businesses, including Redbubble, Cettire, and Kogan.
Yeah, the era of speculations coming to an end there. But another sector punished by interest rate rises was the tech sector. But earnings in this sector continue to hold up quite well. You've got borderline star growth stock Technology One. They released their financial year 22 result over the week. And for those who are not familiar, Technology One, they provide software and cloud-based services to companies within the government, education, and health sectors to help them manage their resources, such as payroll, financials, and supply chains. And the company sustained a return on equity of 41%, also increasing its net profit margins to 24%. And that's due to major contract wins along with a lower tax rate. The stock is now trading close to its record highs, with the share price trading close to its consensus price target. And with a PE multiple of about 42 times, Dan, do we still see value here?
It's a great question, Kien, and probably one that a lot of our members would be asking too. So it's important to remember that technology stocks generally do trade at a higher earnings multiple compared to the industrial companies, and that's due to its higher growth profile. In fact, Technology One has historically traded at a very high earnings multiple, with earnings revisions over the last 3 months up by 9%. It's also important to point out that consensus price targets are likely to be revised higher. When assessing the value of a stock, again, it's important that investors can look past these simple PE ratios and instead focus on the quality of the business, resilience of it, and growth potential. Therefore, we do still continue to see value in Technology One, provided that you are comfortable with the active risks in the stock.
Yeah, nicely put, Dan. And another technology stock to provide an update was global logistics software provider Wisetech. Management did reaffirm its financial year 23 guidance. So why was the stock sold down during the week?
Yeah, it's another great question, and one that we had to ask ourselves as well. And the share price, it really experienced a strong run-up heading into the announcement. So I think the market was potentially expecting an upgrade to guidance. And management's forecast for around 21 to 30% earnings growth appears just a smidge below the mid-30s currently expected by consensus. But even at around mid-20% growth rate, this level of performance is still admirable, considering the company is cycling COVID tailwinds in the year prior.
Yeah, I can see on Stock Doctor also, Dan, that short interest on the stock has been coming down from a year earlier as well. And again, investors shouldn't be concerned with the company trading at such a high valuation multiple with the PE of 72 times on this stock, because historically it has traded quite high. And of course, you can see the founder, Richard White, continuing to hold a major stake in the business at 37%, aligning his interests with those of shareholders.
That's right, Ken. It's great to have that alignment between management and shareholders. And moving on to the corporate calendar, borderline star growth stock Collins Food is expected to report its interim results on the 29th of November. Meanwhile, star growth companies including Objective Corp, Lynas Rare Earth, and Premier Investments should host their AGMs next week.
And now to Under the Microscope, we look at the recent addition to borderline star growth stock, Incitec Pivot. For those who are unfamiliar with the company, Incitec Pivot, they are an industrial chemicals business that specialize in manufacturing explosives at around 53% of their total earnings, with the remaining in fertilizers as well.
That's right, Kien. It's important to remember for our members that Intertech Pivot is a highly cyclical business due to the commoditized nature of the products it manufactures, such as ammonia, which is used in the production of fertilizer. Therefore, its earnings can fluctuate significantly from year to year. As such, Incitec Pivot is more suited to growth investors who want to leverage off energy prices, as ammonia prices are highly correlated to the cost of gas and the agricultural sector.
Yes, and you can see the cyclical nature of its earnings on Stock Doctor, with its return on equity and earnings growth fluctuating strongly from year to year. In fact, consensus expectations does suggest earnings are currently at historical highs and could revert in coming years. So with this in mind, Dan, why have we initiated coverage on the stock?
Yeah, it's definitely one that we deliberated heavily on within the team. And first and foremost, Intertech Pivot is a financially healthy business and it exhibits strong return on equity and healthy net profit margins in those good times in the cycle. Secondly, the stock is positively exposed to rising energy prices, which actually may provide some further diversification benefits within a broader portfolio without having to invest directly into an energy stock. Thirdly, there are catalysts in the near term for share price appreciation, which includes a potential demerger of its explosives business, Donald Noble, and the potential for asset sales as well.
Yeah, very interesting. And with earnings tied to the price of ammonia, which are quite volatile, we should not put too much weight on those forecast numbers, shouldn't we? Instead, those who want to gain exposure should be aware of those active risks right now.
Yeah, and just touching on those active risks, Kien, the most prevalent one is that the earnings are highly cyclical. So a reduction in ammonia prices will impact its future earnings. And you can track this by using the 3-month earnings revisions under Golden Rule 3. Apart from the operational risks and also commodity prices, which also provide active risks, investors should be mindful of fluctuations in exchange rates, since the company does have a large revenue base in the US.
Yeah, and also I can see under Golden Rule 7, earlier on we spoke about the excessive remuneration package of Alan Joyce from Qantas. We're also mindful that this stock has not really generated much return to shareholders at around 3% per annum over the last 5 years. And hence, do we think the CEO, Gianna Johns, is overpaid with a total package of over 4 million?
Yeah, it's definitely one we looked at as well, Kien, and most of her salary is comprised of incentives, which are tied to shareholder performance and returns. So that also does provide the alignment between management and shareholders, which we always view as a positive. And secondly, her fixed remuneration has actually not increased since 2019, according to remuneration report. So we don't feel her salary is excessive in the context of that Incitec Pivot is a large global manufacturing business.
Also, I want to note that similar to many resource stocks, the earnings performance of Incitec Pivot is tied to the underlying commodity prices and really sometimes is outside the control of management despite how good they are. So keep that in mind. Now for question of the week. Earlier in the episode, we spoke about the reopening trade and with Qantas failing our quality screens. A useful question for members this week is, how can Stock Doctor help me identify quality opportunities within the travel, tourism and hospitality industries?
And as we've discussed throughout, Kien, obviously these industries are experiencing some earnings upgrades on the back of strong underlying consumer demand for travel. And what Stock Doctor can do is help investors find opportunities by using the stock filter under tools. Here, you can select sectors within the GICS classification, such as transportation, and you can even filter through airlines, consumer services, and looking at hotel, restaurants, and leisure as well. When building the filter, you can add as many other fields as you like. Here we have included some past financial performance metrics, earnings revisions, ST30 TSR, and also total return. Now, the list isn't perfect because you might have a few gambling companies here, but it should provide you with a rough idea of stocks that are beneficiaries from the reopening theme. Another way to generate a list of ideas is to enter the word travel with the business description field and select all GICS companies.
Yeah, that's amazing. And the great thing about the filter tool also is that you can sort companies based on various fields, including the financial health, earnings revisions, or even SD30 TSR to look for opportunities. And here we can see the financially healthy businesses. We've filtered them at the top. Well, Dan, time has certainly gone so quickly, but thanks for your contributions again today.
It's great to be back here in the festive period of the year. Looking forward to seeing some of those sales today, Black Friday and Cyber Monday as well.
Yeah, we'll be busy looking for online shopping this weekend anyway. But in the meantime, for those who have any queries on stocks or the market, you can really sign up to our Lincoln Live sessions on Monday, where our Chief Investment Officer, Tim Lincoln, and of course, our team of experts can answer your questions and help you navigate through this market volatility. But to summarize the episode for today, in the short term, Financially unhealthy companies may rally quite strongly on the back of earnings tailwinds, but to be successful in the long term, it is best to stick to those financially healthy businesses, those high quality companies with strong profit margins, positive cash flows, and manageable active risks. For now, take care and have a happy, healthy, and prosperous week, everyone.